Hi, this is Rick Savitsky from Chortek. I head up a team of accountants and data analysts, and we love working with manufacturers. We love helping them be more efficient, more profitable by giving them good, timely information and sometimes presenting that information in ways that maybe they haven't been traditionally using. In this video, I'm going to talk about a key concept called applied labor, or the cost of inefficiency. I'm going to define it, give you some examples why it's important, show you how to calculate it, and then show you how you can use it on a regular basis. So with that said, applied labor is an important concept because the cost of labor is likely the highest or the second highest cost in your business, or certainly the cost of what you're producing as a manufacturer. So it's a very high percentage of your costs. The key is how much of the labor that you're paying your employees is directly going into your cost of production. And the challenge that I've seen with other manufacturers and looking at their financials and their reporting systems is they don't have that clarity. And the key here is if you aren't measuring it, you can't manage to it. And the it in this case is, again, what percentage of your labor is actually going into what you're producing, or conversely, how much isn't? What is the cost of inefficiency? And if you can't clearly, easily see that each week, month, day, then there's some area for improvement. With that, what's a definition here? So applied labor itself, we're going to define it. We're going to capture the payroll expenses from the payroll system and related benefits and payroll taxes for direct or shop floor employees. We're going to keep that separate from indirect costs, management, supervision, quality control, but rather the direct costs. And we're also going to measure what dollar value is being applied or absorbed into the cost of manufacturing. So that's the definition. How do you calculate it? Well, using the simple chart of account here, we're basically going to have the payroll system feed only the shop floor or direct employees, their costs, payroll taxes, direct benefits, and we're going to want that separate from other costs for other employees. So it should be very clear on the financial and the chart of accounts which ones are which. This is showing them all together. There could be a class or a segment or a dimension, an extra way of additionally clarifying by work center or perhaps department within the operations. But the main idea is we're going to clearly identify actual payroll, which we can easily compare with the payroll reports out of the payroll system. And then we are going to have a negative number, hopefully a negative number just about the same value as these other direct expenses each quarter, month, once, twice a month, once a week, whenever payroll's run. And this applied labor is being fed by the manufacturing system as your employees are logging their time. So the rate that's used, I'm going to discuss in a second, but the main idea here is if we're paying our employees, say $10,000 a week, and we're logging our time, we want the applied labor, as long as the rate is correct, to get as close as possible to that same $10,000. If it's not, say for a given week, it's $9,000, that means, all right, what's left over, the unapplied labor, is $1,000, or in our example, 10%. That represents the cost of inefficiency. You're paying the direct labor employees, but not all of their time or dollars are going into what you're producing for your customers. And that difference, again, is a cost of inefficiency, and it can be expressed also as a percentage. So how do you feed the applied labor? Well, each manufacturing system is different mechanically how it's going to get done, but to calculate the rate, the concept's very, very, very similar. You're going to take the planned estimated payroll for the next month or the next 3 months, and you're going to divide that by the estimated hours that you are planning those same employees to work. This could be done as one single number, say $30 an hour or $50 an hour, or it could be done ideally in a bit more granularity to match essentially how you are segregating your production, either by machine or work center or cell, And if you expect a certain step on a routing or a component to be incurred by someone with a higher cost per hour, perhaps because that step that's going to be performed requires someone of more experience, it's going to be paid more, you're going to want to be segregating that so that when that time is logged, it's being done at the correct expected rate. So in essence, this doesn't have to be overly complicated, but you do need to make sure that you're truly capturing your direct costs of planned expense, and very importantly, that you've got a real clear plan on how many hours are expected to be incurred over that same time period. So how do you use it? Well, key point here is that you have to set a target. I see this missing in many manufacturers. Actually set a number, a percentage, and then measure it and share that measurement with management, with production, and with the employees, and then work on improving it. So here's a few examples. We commonly deploy Power BI as a very easy way to get everybody on the same page. Large displays in the shop floor, in the break room, on people management's desks. What percentage are we as far as applied labor? And then what's our target? And if you're significantly off the target, the ability to drill down and see either by work center, in this case, or perhaps by employee or employee pool, where are the variances coming? So that's an example of something that you could look at essentially every day, every week. In addition to showing it on the financial statements, calling it out on a management report is very helpful. Again, comparing it either to a change month by month or compared to a target, charting that same thing, that value over time, compared to a target value is another very helpful way of depicting it and putting some importance on measuring. And then finally, I like showing it also as a cost where you're trying to get down to zero. So in this case, the cost of inefficiency, the difference between direct labor and what's being applied, can be charted, and you ideally want it to be going closer and closer to zero. And paying attention to that can help drive activity. It can help provoke discussions. Why isn't it near zero? And that can lead to continuous improvement over time and very clearly increase in profitability for the business, and also helps you with quoting for either new job shop related work or setting your prices as a percentage over your true, accurate, expected costs. So if you'd like help with this topic, if you'd like help implementing it, give us a ring. We'd love to talk to you. If this video is helpful, give it a like, share it with others on social media. It'd be much appreciated. Thanks a lot. Bye.